Good afternoon. Welcome to the ADS Dental Transitions presentation of tax planning and considerations for a dental practice sale. Your co-hosts today are Ted Schuman with DBS Dental Sales, which is an ADS member company, and CPA Chris Van Straten with Baker Tilly. Please note that both Ted and Chris will be available live for questions at the end of the presentation. Thank you for joining us today.
Hi, everybody. I'm Ted Schuman from DBS Dental Sales. We are the ADS Transition member firm in Michigan. And today I'm joined by longtime friend and CPA Chris Van Straten from Baker Tilly. Baker Tilly, as most of you know, has offices nationwide, but Chris has dedicated his office and his division specifically to serving the needs of dentists. And Chris, you're headquartered in Wisconsin, right? Is it Appleton, Wisconsin?
That is correct.
Chris, in addition to being part of Baker Tilly, is also a member of Academy of Dental CPAs. And so I'm so glad we could collaborate today. Both of us have been in this business for a long time, advising dentists in one fashion or another, and we both know how important a good CPA is to our client's success, and that's especially true as it relates to the practice transition process. Would you agree?
I would agree. And Ted, thank you. And I want to kind of just say a special thank you from both Baker Tilly and the AD CPA.
So with that, let's jump right into some of these questions. As far as buyers and sellers of dental practices are concerned, when you're in the heat of negotiation and you're making offers and you're doing all that kind of stuff, as far as a buyer and a seller are concerned, there's really only two prices that matter, two figures that matter. There's the price of the practice, how many dollars that you're going to have to pay for your practice if you're the buyer, how many dollars you're going to receive for the practice if you're the seller. And then the other price, if applicable, would be the building, right? If there's a building involved in the practice transition, there's really a price tag on one and a price tag on the other. And that's the way most buyers and sellers look at it. But Chris, I know guys like you, guys in the CPA and accounting space, when it comes to the transition of a dental practice, the price of the practice is actually allocated among a lot of different categories, right? And each one of those categories has a different has a different consequence or tax treatment. So can you tell us a little bit about how all that works?
Sure. Yeah. So I would say 99% of all practice sales are done as what we call an asset sale agreement or asset purchase agreement. And it usually comprises of three main parts and a fourth being the building. But the three main parts of the practice are the practice assets, the equipment, the tangible things that you can see in the office, and then supplies. There's usually a certain inventory of supplies that are included. And then lastly, and usually the most material factor is the goodwill of the practice. And for the most part, when a buyer is purchasing the practice, that goodwill is really the asset that is most important, because they're buying a patient flow. They're buying patients that have been connected to that practice for a long time, so they can hit the ground running. And that's really what the goodwill is primarily made up of. So. Now there's also two parts of goodwill that we kind of break into usually, and that's corporate goodwill and personal goodwill. And they have potentially unique tax circumstances that most importantly are just to be aware of. There might be cases where somebody is selling their practice and it's what's called a C corporation as a corporate formation, and the personal goodwill allocation can be very, very important in that type of an arrangement, especially.
So Chris, if I'm representing a doctor that's selling his or her practice and they've operated as a C corporation, are you telling me that there's corporate goodwill and personal goodwill that seller needs to be aware of, or is it just one or the other?
I would suggest that they should be considering both. In most cases, I would say in a C corporation sale, we're looking at primarily personal goodwill to bifurcate that from the practice. And and to separate it because it has very dramatic tax consequences. In a C Corp, that goodwill would be effectively double taxed. If it's deemed personal goodwill, it would only have one level of tax, and it would be personal capital gain, just like as though they sold a stock with a long-term gain. So the tax differential could be as much as 20% in that type of situation. And we really stress that when they're doing a transaction, they want to make sure that's a separate part of the deal and very specifically allocated. Most of the time I would recommend a separate closing statement. You want to make sure that if it's personal goodwill, those funds on the sale go into their personal checkbook and not be commingled into the corporate checkbook, and kind of small details that are involved but are very important to making sure you do your best to protect that taxation treatment.
So if I'm working with somebody to sell their business and their business is organized as a C corporation, one of the best things that I could do would be to work with them to have the attorney draft probably a separate purchase agreement for the personal goodwill, make sure the proceeds for that part of the sale are deposited into their personal checking account, not the corporate checkbook, right? Those are going to be the things that are going to help that seller get the goodwill tax treatment. And you touched on this a minute ago, and I want to make sure it didn't get lost in the shuffle. Why is the taxation, why is the goodwill tax treatment such an important thing? What's the benefit there?
Well, so going back to those three key parts of a practice sale, no matter what kind of organization it is, again, usually goodwill, equipment, and supplies. And the sale of equipment is usually allocated where, most practices, when they buy a piece of equipment, at least in the last 5 to 10 years, have probably expensed nearly all of that equipment immediately because of the tax rules that have been allowed for. So when they go and sell that equipment, that depreciation, or 179, some people might refer it to, has been taken when they actually purchased the equipment. Now when they're selling it, it's going to get recaptured at what would be ordinary income tax rates. And again, if a taxpayer is in the highest tax bracket, which is likely the case potentially in the year of a sale, especially, they're probably going to pay somewhere in the neighborhood of 30 to 40% taxes on a minimum basis, whereas with a capital gain, they'll probably pay about 24% or something like that when you combine federal and state taxes.
So when you're selling the practice, the goodwill is going to be treated kind of like you said at capital gain rates, a little bit closer to that 24% rate. Anything that you can't get capital gain tax treatment on, like the equipment and supplies, you're going to pay ordinary income tax rates on to, that 30 to 40% that you were just talking about. Is that what someone would take away from this?
That is correct.
So the punchline here is that if you're the seller, the more that you can get, the more of the sales price that you can have considered as personal goodwill, the better off you are, the less tax punitive the transaction is going to be. Is that correct?
That is correct.
So Chris, what would be a good rule of thumb if one of your clients walked into your office, or in this day and age called you or got on a Zoom meeting with you, and they said, "Hey Chris, good news! I found I found the right buyer for my practice. I'm going to retire. I'm going to ride off into the sunset." How much of a sale price of a practice would you tell them would be reasonable and realistic to assign to goodwill, where they get that lower tax lower tax rate on it, as opposed to the equipment and supplies where they get the uglier tax rate? Like,
it's hard to say that there's a rule of thumb. If it's a situation where most of the equipment is 5 years or older, I would say it's somewhere in that 80 percentile of the purchase price is towards goodwill on a typical basis. If the equipment is modern and in really good repair, you could maybe argue more towards the equipment side of the transaction. And of course, every transaction, there's going to be exceptions to what's involved. You could have a practice that's been in existence for for 25 years, or you could have a practice that's been in existence for 5 years. In cases where the practice has not been around as long, maybe that allocation is not quite as high on the goodwill, but in many cases it's in that 80 percentile. On that topic of goodwill, I'd like to emphasize that if you've got corporate goodwill and you've got personal goodwill, it's important to recognize that if there's a non-compete involved, that needs to be considered at the corporate level and or the personal level to make sure that the goodwill either way is protected, and that non-compete is critical to that policy. But as far as the value allocated to it, it's usually low because it's no tax benefit for either side, and I've never seen it argued.
Good. It's a good reminder that just as a broker like me and a talented CPA like you are important to this transition, so too are good attorneys. Very important in putting together a successful transition because of items like this. Covenant at the corporate level as well as at the personal level, and
if the attorney is familiar with dental transactions, I mean it's very helpful because you can you can get to the right answer fairly quickly with the familiarity of the types of transactions that we're dealing with personal service corporations, which are unique.
For sure. So we talked a lot about corporate goodwill, which is, check me if I'm wrong, that's only relevant to doctors that organize as a C corporation, correct?
Generally speaking, yes. The one caveat that I would add to that is if goodwill has been acquired and amortized and then being resold, the corporate goodwill is again recaptured at ordinary rates, even in an S corp type transaction. So it can be a factor, but it's usually most important in the C corp transaction.
Okay. So if I'm, with so many doctors these days organizing as LLCs, either taxed as S corporations, partnerships, or even sole proprietorships, there's still goodwill that's sold when the practice transitions, right? Yep. But under those circumstances, it's all considered personal goodwill, correct?
Generally speaking, that's what we're targeting.
Okay.
In the transaction, and again, I'll use an example. If I've got a buyer that acquires a practice and then 10 years later sells the practice and they've written off 3/4 of the goodwill when they sell, even in an LLC environment, they would still pick up some ordinary income on that goodwill for what they amortized out.
And that's a great reminder, Chris. I'm thinking about how many practices these days were acquired at the sort of beginning of doctor's career. And then sooner rather than later, maybe the current owner gets a great offer from like a DSO, and yep, the practice is sold to DSO or some other group arrangement. But my point is that I think you're seeing practices turn over much earlier in the life cycle than maybe they've turned over historically. So that purchased goodwill that you were referring to can kind of come back to haunt the seller if they sell it maybe a little bit earlier than their predecessors might have. That's a great reminder, and yep, it's something a lot of people lose sight on. Let's go to the equipment and supply piece for a minute. As far as the supplies are concerned, do the buyer and the seller actually, do they walk into the supply closet and count all the boxes of gloves, or how do they actually assign value to things like equipment and supplies, where it could be a little bit either subjective as far as equipment is concerned, you're just buying used dental equipment, or the supplies that could be true one day, and then you walk in Monday morning and half the stuff's been used up in the day's production. How do you address a situation like that?
Yeah, we usually use a benchmark. Maybe it's 1 month's worth of supplies expense, or something like that to look at, or if it's a solo practice, in that $10,000 to $25,000 is probably going to be your supplies number, and then the equipment is usually the remainder. And then you kind of look at the three parts and make sure it seems reasonable, both both buyer and seller have to agree on that allocation. There is an actual IRS reporting form 8594 that both buyer and seller will have to sign off on and report on the transaction and agree to that allocated purchase price for disclosure.
So even as bright a guy as you are, it sounds like this is part art and part science in terms of how you allocate this price. And then to your point, both the buyer and the seller have to agree. And I'm sure there's maybe a tiny bit of negotiating that happens in terms of what the allocation needs to be in terms of whether or not the seller is trying to accomplish more or whether or not the buyer has more tax strategy on their side.
We would usually, just so that there's not questions later, we'd usually include that allocation or a proposed allocation in the initial letter of intent so that it can be kind of part of the early discussions and not come up on a later issue.
That's a great idea. I think that makes a lot of sense. So everybody kind of has a starting point, right?
Yep.
So let's talk about the fun things. One of the things that a lot of my clients have done over the course of time, per guidance from their dental CPA, guys like you, is they will often have their vehicle in their business. They'll often have the practice own their car and kind of write it off as a company car, so to speak. When a client's doing something like that and they're getting ready to sell their practice, well, that's something where the vehicle could be considered an asset of the practice. What do we do so that doctor doesn't have to go out and buy a new car the day after he sells his practice because he sold it with all the rest of the stuff?
Yeah. So I don't want to say every transaction is the same again, but in 99% cases we would have standard language basically saying that there are certain assets not included in the sale, and those would be listed in the asset purchase agreement and specifically exclude certain assets, and we'd want that asset to be listed, or we would try to look at it prior to as part of the planning. So we like to talk to the doctors hopefully early in their stage of planning for a transaction, and there might be certain things that you'd try to clean up or remove from the corporation, so that's not even a discussion item. And assets like a personal vehicle, if it makes sense, maybe we would get it out of the corporation before any transaction is even negotiated. So
what's the process? So let's say, for example, we have a client, we're getting in the fourth quarter here this year. Doctor thinks, maybe they're going to be done here at the end of the year and sell their practice in early 2023. What would doctor do? What would the consequences be of getting something like the company car out of the corporation and over into doctor's, more personal name? What would the tax consequences of that be? How would that be handled?
In a nutshell, we'd have to look at the value, okay. Maybe it's a trade-in value or a blue book value, and it would either be distributed or bonused out to the doctor to get it out of the corporation and into their personal assets.
So as though they took that same amount of dollars in the form
Correct.
of a draw or a paycheck. Huh?
Yep.
Okay. You mentioned something that I think bears repeating. And that is the planning stage of this. I think you and I would both agree, and we've probably seen in our respective careers, the more proactive, especially a seller can be in planning the transition, the more tactical we can be and the better advice we can give them. I think you and I would probably agree on that.
Yeah, the earlier they can engage in their advisors that this is this is part of their plan and part of their goal. It can be years ahead of time to start laying out expectations. I always think many times the most successful transactions are just meeting expectations. And the sooner you start talking about that and setting the tone and having an idea, related to values, related to structure, related to what's going to happen to my employees, all of those kinds of things before a seller ever has a discussion with a potential buyer. that to me is really critical to a successful transaction.
Absolutely. Absolutely. So we talked a lot about the sale of the practice. Let's switch gears to the building for a minute. For those transitions where where there's a building involved, what's the consequence for the sale of a building? I mean, that's handled as a separate transaction, I know, but from a tax perspective, what's the tax consequence on the sale of the building?
Yeah, so a building, we of course don't have a goodwill issue with a building. There's not an allocation for that. So with a building, there's really an allocation between land and buildings that is part of that transaction. But most buildings are depreciated over 39 years, and we look at the basis of the building, and the sale price less the basis in the building, of course, is going to be gain. And any value allocated to the land is capital gain. On the building side, that depreciation, again, you've heard the term recapture. I think I was talking about a little bit before on equipment. Building has a similar factor, although it's not quite as harsh. On most commercial buildings, the depreciation is 1250, what we call 1250 recapture, and it's recaptured at a 25% tax rate. So it's not at the ordinary highest tax brackets, but it is kind of a middle, I'll call it a middle rate. And so anything that's been depreciated on the building where we have gain, that is recaptured first, and then any excess sale price would be capital gain. Now, a building is a relatively unique asset. We oftentimes will have doctors that maybe they want to still lease that building. Maybe that's part of their retirement cash flows that they want to maintain. Other transactions, they want to sell, and they're out of town. They're going south or whatever it may be. They just don't want to have any responsibilities, and either way is okay. Again, I think it's planning appropriately. If minimizing taxes is a primary driver, and in the sense that they don't really need that sale price for that building, they're going to have in the year of sale, they've got potentially income from their regular earnings, income from the practice sale, and now you've got a building sale. So the need for cash isn't necessarily the same. So we try to basically work with the doctor's desires in figuring out what are their goals. But if they're willing to hold on to the building and or still be an investor with their building asset, maybe they want to look at a sale, be done with their sale, but they want to reinvest those proceeds. They can look at a 1031 exchange or a like kind exchange, and or there are other assets to. There's these qualified opportunity zone investments that people might hear about. Those are legit opportunities and things to look at. Now, I think you and I both agree that we don't let the taxes necessarily drive the whole transaction. It needs to be a good investment at the end of the day, and maximizing their investment return is first and foremost. So whatever investment, if they were looking at a like kind exchange type investment on a sale, certainly making sure it's a good investment is first and foremost. Lastly, on the building, I would say is related to an installment sale type structure, and we could do that on both the installment basis for the building and or the practice. What I will say is an installment sale on the building is possible, and you can defer the gain over the installment sale. Say if it's a 5-year period, you can stretch that gain out on a prorated basis. In a practice sale, any gain related to equipment or supplies that you cannot defer. So I just want to kind of highlight that with a building asset, you can usually work around the 1250, but in a practice sale, the only part of that gain that can be deferred is related to goodwill. So
So
covered a lot there.
So I want to actually come back to that because I think that's a very intriguing concept. You know, the whole theme of this webinar, the whole theme of this broadcast is managing taxes. So let's maybe go back to some of that for a second. You raised an interesting point where you talked about the year a doctor sells could be a very high income year and by extension a very high tax year, right? So especially if they have the sale of the practice, they have the sale of the practice, they have the sale of the building, and whatever income or profit they made that year. So one of the first questions I would ask is, do you ever advise your clients to decide they're going to sell the practice maybe this time of year, but not actually sell the practice until the first week of January, so they have a more pure tax year to work with? What's your outlook on that kind of strategy?
I'm smiling a little bit because I got one of those going on right now.
we all do, right? I mean, as bright as we are, we're not the first ones to come up with that idea, right?
Yep. So yeah, there's a couple of things there that you noted, Ted, in talking about, you know, the timing of the sale and how it impacts taxes. To kind of unpack that, number one is if you can spread the gain between 2 years, you can potentially use up lower tax brackets over those 2 years. The other thing that adds to that benefit by having the gain in a future year after they've retired from the practice, I always say, is not only is it higher income year for that year, it's probably the highest income they're going to have in their lifetime. Mm-hmm. And so what things do we want to look at for their lifetime planning that may make sense in that year of sale? For instance, if a client has charitable goals, it's a prime opportunity to take advantage of charitable giving in a year of sale to offset some of that value. You get to see the benefits of that in their lifetime. They're not wasting it, in the sense that I have several situations where clients have sold, and then, you know, throughout their last 20 years or 15 years, they've been paying taxes at their highest rates, for example, in that 30 to 40 to 45% tax rates. And now when they're retired, they're paying 25% tax rates. So whatever we can get into those tax rates is so valuable, and looking at ways to bunch transactions is really a huge planning tool. So I just want to kind of emphasize the value potentially of that. If there are things that are going to get paid, I also talk about retirement plan in the year of sale. You know, if they can do the funding, if they have a cash balance plan, they could do a max funding in that to, again, just get that year of sale income down and spread it out over the rest of their lifetime, almost like deferred compensation. Mm-hmm. In some respects. It doesn't work every time, but there are unique circumstances that maybe it does work. And so just having awareness around that and talking it through is very valuable. Now, I'll say you have some risk when you do an installment type sale or a deferred sale. I always emphasize that. A doctor is going to sell the practice, and now, you know, no matter what happens, if they haven't been paid, there's always risk to collection. And so you got to be comfortable with the fact that you're selling an asset, and hopefully everything goes well, and there's no risk of future collection if you do choose an installment sale. But recognize that risk, and if it's going to keep you up at night or something like that, again, not letting the tax wag the tail all the time is you know, it's got to be the right strategy.
You hit on some great planning opportunities right there, and I want to just go back and mention a couple of them for anybody who's watching this. The first one that you mentioned was, you know, the year of sale can be a big tax year. What can you do to mitigate that? I think you You touched on charitable giving and that kind of thing. I've had a lot of clients use what's called a donor advised fund on the year that they sell the practice, which is a very cool strategy where they can take a deduction for a big and Chris, stop me before I get in trouble here, but they can take a big charitable deduction for money that they put in a donor advised fund but doesn't actually get doled out to a given charity until subsequent years. You could put a bunch of money in and, you know, give away maybe 20% of it a year for 5 years or something like that. That's a strategy that's worked very well for a lot of our clients, especially my clients that are charitably minded. And fortunately, I've had a lot of very charitable clients over time. That's a tactic that's great.
They've gained a tremendous amount of popularity, at least from what I've seen and heard in the marketplace on, you know, those donor advised funds, because clients can still maintain control over those funds. They can still see the investments grow if that's their goal, and yeah, they can dole it out in most cases whenever they want, based on the flexibility in most of, I don't want to say all funds, but a lot of the major funding or investment houses now offer strategies around that.
No, and it's a great idea for the right for the right set of circumstances. One of the other ones you touched on is having the retirement plans in the years leading up to sale, and if doctor's going to stay on as an associate for the buyer, that can be a great thing to keep active for even 1, 2, or 3 years following the sale. I know, Chris, keep me honest on the numbers here, but you can typically put 65 grand a year into a 401k with a profit sharing component. You can put 150-ish into a cash balance plan for those clients that sponsor cash balance plans. Those are great places to plow cash into in a tax deductible way for a big tax year like the year of sale is going to be. And if you do, a lot of my clients have been very fortunate. They did some proactive planning in the years leading up to the sale to implement those plans. They worked with their CPA, they worked with their retirement people, got the plan set up. They plowed big dollars into accounts, not only did it build the portfolio, but it gave them a great tax deduction in the years they really, really needed one.
Yep.
And they were very fortunate to take advantage of some of those planning opportunities.
I would agree that, and again, I think a lot of that comes into longer term planning, that, you know, utilizing those plans. You don't just come up in your year of sale and decide, oh, now I'm going to do a cash balance plan. It's usually something that you put in place for about 5 years at a minimum. And yeah, you need to kind of look ahead to some advanced planning, and some of that is just helping the selling doctor understand their own cash flow and where are their funds going to come from to allow them to put large sums in and balance that tax liability.
You're exactly right. You indicated the risk on an installment sale, and I think that bears repeating. That one of the coolest things about selling your practice on an installment sale, and any bankers that are watching this, cover their ears right now, because bankers would just assume that the buyer go to the bank and borrow a ton of money and pay off the seller, right? But if you're selling a practice on an installment sale, it's a really cool thing that you can, make payments. The buyer makes payments over time. You recognize the capital gain on the goodwill over time, and it can help sort of support your retirement cash flow. Hey, what a cool idea! But you mentioned the risk, and Chris, I think that can't be minimized. I think the risk is very real, and there's a trade-off between getting cash in your hand versus getting payments from a buyer over time. Now, typically, dental practices have a failure rate of less than 2% nationally. It's, there is very little risk, but there is some here or there. Chris, one of the things that I would ask you, if a seller were going to do an installment sale, do you think they would be better off to do that on the building where there is a more tangible asset that kind of acts as the security or the collateral on that installment sale? Or do you think they'd be better off to do it on the practice? What do you typically recommend?
Yeah, Ted, that's a great question. I would say you would do it on the building if you're choosing for, you know, where are you going to try to do some deferral? I think the building is a more natural place for that because of it being a tangible asset. Like you mentioned, it provides an easy way to connect security. Not that you can't do that with stock or something like that, but it certainly has more complexities in what I would call the practice environment. But yeah, I think the more natural asset for installment basis would be a building transaction. You know, for the listeners, Ted, I would say, you know, everybody's familiar with a land contract, or it's like having a mortgage on the building. You're now the investor on that and being paid, you know, as the bank. So, and today's interest rates, that may not be a bad deal.
It's not a bad way to diversify your retirement income, right?
No.
Yeah. You know, so a lot of times, I will confess, a lot of times when I've seen things like installment sale and that kind of stuff, it's been when there was a sale to the owner doctor's son or daughter is coming up in the dental practice. They went to dental school and they're ultimately going to take over the practice, and mom or dad as the seller is going to let the son or daughter make payments to them on an installment basis and that kind of stuff. You know, one of the things that you mentioned that I've seen work in this strategy, and I'd like you to maybe provide some context for, is when the selling doctor is going to stay on. You know, maybe in this case it's a related party kind of thing. Maybe the selling doctor is going to stay on. They're going to stay on as an associate in the practice. Have you ever seen maybe a lower price paid for the practice in return for a larger associate compensation after the sale? You know, some creativity from that standpoint. Is anything you've ever used with any of your clients?
Yeah, I've used that a few times, specifically around, you know, with a relative or a father-daughter or father-son, mom-son relationship. If that's the transaction that we're negotiating, a lot of times there will be future employment involved in my experience. And so, you know, we'll set up price and quite frankly, in those transactions, I have generally done them as stock transactions and use that as a way to, again, minimize capital gain and not have ordinary income for parent selling if that's the relationship, and kind of manage it where, to me, the most important thing when you got a related party is agreeing on what's our goal. Is our goal to set a price that is market value, or are we looking for a target price that's, you know, reasonable, so to speak, and works with the whole family? Because I think there's usually family dynamics involved there, and mom and dad want to be fair to all parties in the family, and so we work out the transaction accordingly, but try to minimize through both gifting and stock type transaction between the related parties to and then we give the tax savings, we share it between them appropriately.
So you said something interesting, that you'll do a stock transaction, like the younger second generation owner will just buy the seller's stock from them the same way they'd buy stock in any publicly traded company?
Correct. Unrelated party transactions, you don't do stock transactions on a general basis because of the risk involved. When you've got related parties, they naturally have more trust between them, and the risk of what they're taking on is different, I guess, for lack of a better word. And so in a related party transaction, you know, doing stock type transaction has worked for my structures and in most cases.
Now, Chris, does it have to be a C corporation for the sale of a stock strategy to work, or can that work for any entity type?
Generally speaking, I would say that's for any entity type.
Okay, so even if the selling doctor is an LLC taxed as a sole proprietor, they could still do the stock sale strategy?
Yeah, with the LLC, if it's a single member LLC and they're taxed as a sole proprietor, that would, I should qualify that.
Okay.
That would be, yeah, that would have to be an asset transaction. But if it's an S corp, or a multi-member partnership type arrangement, that would work. So
Okay. And I think what you were suggesting earlier about the trust is that there are probably some attorneys out there, rightly so, that would advise a buyer client of theirs, hold on a second, you don't want to buy the stock in this corporation because, or buy the stock that, formerly owned by the seller, because you're going to inherit any headaches or skeletons in the closet, by virtue of buying their stock from them. If you buy the assets from them, which is how most dental practice transitions are culminated, then you're your own business who just happens to be, by coincidence, operating on the same patients and in the same space as the predecessor, right? That's the asset
Correct.
side of it.
Yep.
So to your point, you really have to know and really have to trust the seller before it makes sense for you as the buyer to engage in a stock purchase.
yeah, it's probably, I don't know, ratio is probably 99% or something like that, I think, of asset transactions versus stock. So it only works in unique circumstances.
I like doing transitions between family members because I believe they allow for the most creativity, and that's one of the coolest things about being involved in ADS transitions, is that we're a very creative group of practice brokers. Don't necessarily just kind of stick to whatever the cookie cutter model is. I think you hit the nail on the head a little bit earlier that there has to be some planning and some type of meeting of what the overall objectives are for a given transaction, and then it can take any form that fits for the buyer and the seller, right? It doesn't necessarily have to be be sort of off the shelf. So
we're talking about generalities here, right? But most transactions are on par with what we're talking about, but every transaction has some unique circumstances to it, and require some level of planning and negotiation and working through the fine details. So I think the ability to have work through transactions like you have, Ted, and being a practice broker, that allows for experience and being able to develop and ideas on how those transactions can get done. So, I think those are valuable tools to add to the transaction.
it's just, now what about as far as, like, I'm going to call them transaction fees or fees associated with selling the practice. So when I'm selling a practice for a client, they pay the company a commission. There's always legal fees for the attorneys drafting the documents, and I'm sure accounting fees for guys like you that are advising on the sale and closing out the corporate books and all that kind of stuff. Are doctors able to write any of that off against the sale of the practice, or how does all that work?
Yeah, all of those fees should be a deduction against the sale, and or maybe there's consulting fees related to it that are an ordinary deduction as well. So all of those fees should be valid expenses to offset against, similar to selling a house
Sure.
or something like that. But yes, those should be allowed for.
So the other costs associated with the actual transaction of selling the practice, there's tax efficiency there, and obviously sellers should work with their dental CPA on how to capture all that stuff. So I've got just two more questions for you. The first one is, most of this conversation has been sort of seller centric, because the seller in most dental practice transitions is the one with the most tax consequences. They're the ones with the most at stake from a tax perspective. What about the buyer? What types of things should a buyer keep in mind, or what kind of strategies would a buyer want to be thinking about to help them on their side of the equation?
So on the buyer side, I think there's a couple things. One is, we come back to the conversation we had on the allocation of the purchase price. So a buyer is, they get to write off goodwill, but it's over 15 years instead of, the purchase price that's related to supplies or equipment. They might be able to get the write-off either immediately or over a 5-year period or a 7-year period. So time value of money for the buyer is a factor. One caveat I would add for a buyer is getting the write-off 100% of that equipment purchase in your first year of purchase is not always the best strategy. The reason I say that is your income is likely going to be higher in future years. So by deferring some of that deduction to future years, it actually is worth more because you can get it at higher rates. If there's anything for a buyer to remember, know about that rate factor, because I see it too often where I will take on a new client and their prior year income was zero or a loss, and they really didn't have to have it that way because they could have elected a time period different than what was taken. So I highlight that. The other thing is, especially if there is a building involved, the ability to look at a cost segregation type analysis, I think is a pretty critical factor. Looking at the building to figure out, can we write off components of the building and get to that 5-year or 15-year life on certain assets of that acquisition. That would be, I think, another critical opportunity.
So the punchline on the cost segregation is that if you buy a building left to the code's own devices, you're going to write it off over 39 and a half years, and that's 15 years longer than most people are practicing, right? Whereas if you do a cost segregation study, that's where a group comes in and they do sort of an engineering study and analysis, and they for lack of a better word dissect the components of the building and say, okay, this much of the building is building 39 and a half years, love it or hate it, that's what it is. But these components of the building, and thus this part of the cost, are actually more unique and can be written off over shorter periods of time. 5 years, I think, like what you just said. Is that true?
Yep.
Yep. And
that is true.
When you're buying a building and there's big dollars involved, you don't want to recover those over 39 and a half years. Any of that you can recover sooner is obviously better from a tax perspective. So I know that there's not necessarily an easy way to tell the future, but I have to ask you, being the expert, is there any pending tax legislation, any bills floating around, anything like that a dentist would want to know that a dentist would want to know about relative to what's going to happen with taxes if they're going to sell their practice? So if I had a client that's looking at selling their practice, maybe at the end of this year or the end of next year, is there anything that you are seeing or hearing that might change the tax dynamic and make it better or worse, or there would be some planning opportunities that they could take advantage of? Anything like that you're seeing or hearing about?
On the front of taxes right now, it would seem like depending on what this midterm election is going to be like, if there's not a major change, I think we maybe will stay in a similar environment. If we're in a split Congress, it seems like this $400,000 number that has been talked a lot about is almost a line in the sand of where rates are going to be higher or lower. So, use that for what it is. That the general sense is we've taken on a tremendous amount of debt at the governmental level, and that debt has to be repaid someday. So, rising tax rates are a possibility, but I certainly would not, I would not push myself into a transaction right now thinking that, oh, geez, I got to do this now because tax rates are going to go higher. It seems like right now we're in a relative environment that the rates are maybe about as high as political aspects will allow. So
They're as high as anybody that wants to be reelected is willing to push them. Is that what you're telling me?
seems to be the position, but I think that as much as we do talk about reducing tax, I think the focus is to try to make sure you're maximizing investment return and negotiating the best possible transactions, whether you're a buyer or a seller, and focus on what is the opportunity within that practice, and taxes, have a good dental CPA, and plan accordingly for whatever exists at that point in time.
Great point, great reminder, and especially here as we're going into the fourth quarter, I'm sure you're doing a tremendous amount of tax planning with your clients, both your clients that are going to be practicing into the future, as well as your clients that are maybe getting to the end of their career and going to be planning their exit strategies. So, Chris, this has been fantastic. Every time I talk to you, I always pick up something new. A lot of great planning opportunities as it relates to the allocation of a price and the sale of the practice, whether or not it makes sense to do installment sales, where there can be opportunities for that, where there can be opportunities for stock sales and things of that sort. Of course, using the retirement plans as a means of sheltering some of the sale of the practice is a great thing. Cost segregation study, I think, was a great conversation. There's been a lot of great stuff here, Chris. I can't tell you how much I appreciate you being part of this session. So thank you so much.
Well, Ted, thank you for allowing me to participate and share, and of course, if there are questions ever, I'm always available. So appreciate it, and please don't hesitate to look up from I'm going to give a little plug for the Academy of Dental CPAs, adcpa.org. Look up our members there and bakertilly.com. Thank you.
Thanks again, Chris. I really appreciate you being involved in this, and I know everybody on the session today took a good nugget or two away. So thank you for everything.
Thank you, Ted. Great job on your side. Appreciate
Thank
it.
you.
Okay, and we have Ted and Chris available to take your questions now. It appears we already have some questions. Ted, can you read those on your screen?
Certainly. So the first question is regarding real estate. What is meant by basis, and how do I find out what my basis is? And I'm gonna let Chris answer that one.
Sure. Well, hello, everybody. As far as the basis that you have, there should be a depreciation schedule that is related to your building, and effectively the basis is whatever from your original cost and what you've invested over time, less what's been taken as an expense deduction for depreciation would be your net basis. So hopefully there would be a schedule that would be available on your tax return that kind of shows that net number. So if the building hasn't been depreciated or something like that, it's certainly something you'd want to discuss with your CPA and evaluate what would need to be adjusted for based on that.
Now, Chris, when you're buying a building, you have to allocate some price to land, right? Some of the purchase price to land, and the land is not depreciable. Is that correct?
That is correct. So yeah, your total basis is going to be broken out between the actual building and land, and add those numbers up, and whatever's not been depreciated so far is your remaining basis to offset against the sale price.
Great. Next one. I'm considering a proposal from another office down the street. The younger doctor would like us to merge our practice into their location. What are the implications for us as the seller in this type of transaction as opposed to a traditional transaction? So it sounds like there's a merger opportunity available. Seeing a lot of that in the marketplace, it looks like the buyer kind of wants to buy this other practice in town as a merger, bringing it into the buyer's pre-existing practice. So, Chris, what are your thoughts on that?
Well, I think if it is truly going to be a merger and the owners of both parties are going to continue to be owners, I would definitely want to look at opportunities for a tax-free type merger, assuming that can be accomplished, which in a lot of cases, based on entity structure, certainly a merger can be complex and have a lot of tax pieces related, but a lot of times we can accomplish that in a tax-free way where the two parties merge and it doesn't have a tax effect to either side. Of course, if there's going to be a buyout that's part of that merger, that would have to be dealt with independently and considered as part of the overall transaction, and make sure the those that might be selling, if anybody is selling as part of the total transaction, would have to be considered.
I would agree. Chris, I think definitions is one of the most important things to be discussed with a question like this. I always joke that mergers are very popular in corporate America and on Wall Street. Typically, when it comes to local independent businesses like dental practices, call it whatever you want, but in reality, somebody's getting bought and somebody is getting sold. So I think that the ramifications are different, to your point, in terms of whether or not it is a true merger in the sense of just two companies coming together and sharing operating expenses, as opposed to somebody buying a practice so that patients come into their pre-existing practice, basically acquiring a practice for market share. Often that's referred to as a merger, but in reality, it's a purchase. And
maybe I would add to that one part of the question. Of course, we don't know all the details, but I would think it would be likely that some sort of a potential, if there are some retiring individuals involved, the deferred compensation would likely be a part of that transaction, which is different than an asset purchase or a stock or membership interest type exchange. So, but it sounds like the entity would continue on and maybe there's a way to structure a long-term deferred comp agreement that also can be beneficial to all parties.
Very, very creative, Chris. I like that suggestion. We have a couple questions regarding buildings. One of them, and I think this is a great question. When clients want to buy a practice and possibly also a building, what do you advise them to consider in making that decision? And I'm going to throw just a couple of the things that I always advise buyers on when they're considering buying a practice. The first thing is, does this practice fit you? Is it the type of practice where you are going to be a very natural successor? Is the treatment philosophy the same? Are there synergies from that standpoint? And then, the more obvious economics. Is the practice big enough to pay its own overhead, pay you a reasonable compensation, and pay any debt service? So does it make enough to pay the overhead, pay the owner, and make the payment? As far as the building is concerned, that really varies market to market. There are some markets, real estate over the last couple of years has certainly appreciated in value. There are some markets where a buyer of a practice has no choice but to buy the building, either because the seller is only going to sell it as a set, or because they don't have any other alternatives as far as facility is concerned. Other markets, not so much. There's business real estate open and available all over the place, and the buyer has more flexibility. But I think the building too comes down to cash flow. Is this something that the practice can support, and by extension the buyer can afford? Chris, what are your thoughts on that?
Ted, I would agree. I think maybe another part of that might be in a transaction. If seller is willing to hold the building for a year or two after sale, and buyer and seller can work out like an option to purchase agreement. I'm finding that's pretty common with new doctors buying a practice, that it just works well with financing, that they buy the practice first and then rent for maybe a year or two, and then acquire the building. It's a little more financially viable for them, not biting off as much debt at the get-go. And again, sometimes that can work well for the seller as well, by stretching the sale of two assets between different tax years and spreading it out a little bit. So if something like that can work, that can work well.
I think you actually may have just answered the next question, and that is it better to sell the practice and the building in 2 separate years? For example, maybe selling the practice at the end of this year and then selling the building in early 2023, or maybe to ease cash flow 2024, 2025. So, sounds like you think that there's a lot to be said for that strategy.
A lot of times that works out well. I mean, every transaction again is unique, and everybody's tax position is unique. But a lot of times by spreading the gain between 2 years, again, you get to use up tax brackets that maybe you otherwise would just be taxed at the very highest rate on both transactions. So spreading your gains between tax years is usually favorable. But somebody could have a big gain coming on some other asset that we don't know about. So I always say, consider your situation, but spreading the gain between years is usually positive.
Question that came up on that regarding real estate: is the capital gain rate on real estate the same as it is on other assets?
The actual capital gain rate is. That question might be asking about depreciation and the recapture of depreciation, which is different. Usually on a building, it's a 25% tax recapture rate for federal purposes of the amount of depreciation taken.
Okay, so it's 25% on the depreciation recaptured. What about on the actual appreciation in the value of the building?
That would be capital gain and tax, just like the sale of a stock. That's long-term capital gain. Long-term
capital gain, and refresh my memory, is that 15-20% somewhere around there, Chris?
So that would come out to be, when you combine federal and state, I always say it's usually about 20% total.
Okay, still considerably better than ordinary rates in most cases, right?
Yep.
Okay. Looking at other questions. Oh, this is a great one. Should rising interest rates affect your timeline in selling the practice, assuming it reduces the sale price of the practice? That's a great question. We've had the Fed raise interest rates at a pretty good clip this year. That's what they're doing their best to do to fight this inflation that seems to be sticky and stubborn. So far, I'm going to say that has not impacted the sale of practices yet. Now, the expectation at the macroeconomic level is that it will, because that's why interest rates are being increased to begin with, is to sort of slow economic growth. I think another interpretation of this question, or maybe another extension of the answer, is that's something that should be particularly considered for anybody selling their practice or building on an installment sale, which is something we spent a few minutes talking about today. Chris, any thoughts on that?
I would echo what you said. I think it should start potentially impacting values, but I haven't seen it per se in the marketplace. I know it's rates today are for those of us that have been along for a long time. These rates are probably more more normal than what has really been seen for the last, say, 10 years. So, but it's certainly understood that the goal here in the market is to slow things down, and it certainly does make it more expensive when you add a couple of percentage interest rates to, say, a $1 million transaction. It does impact the payments. So
I agree. A couple more questions here. One of the things we didn't talk about, at least we didn't talk much about, Chris, if a doctor is selling a practice and they're selling with it accounts receivable, so they're selling the practice and they're also selling money owed to the practice as of a certain day, how's that treated from a tax standpoint?
accounts receivable, generally speaking, is going to be just like they collected it while they were in practice. So it's going to be ordinary income to them, possibly even paid as wages to them, depending on the transaction between buyer and seller and how that's ultimately structured. So I think it's important to realize that, that accounts receivable has not been recorded as income as of yet. So ultimately, when it's collected or paid upon, it in some cases it's deemed what's called a hot asset, meaning it has a built-in gain to it, and you got to pick up ordinary income from it.
But as the buyer, if you're buying accounts receivable from the seller, you get some preferential tax treatment on those collections, don't you, Chris?
You would get to write that off dollar for dollar. So
you get to collect that tax free, basically, right?
Correct.
Yeah, that's a pretty good deal for the buyer.
Yeah.
Question, we didn't talk much about this, but it relates to unemployment rate. When a buyer buys a practice, they inherit the seller's unemployment rate. Now, is that true? Is that true only in the event of a stock sale, or is that true in an asset sale as well?
I would say in most cases it's true. I mean, you have the option in most cases to take on the seller's unemployment rate. It's not required. You actually usually make that choice. So you would look at it, and if that rate is favorable, then you have the option as long as both parties cooperate.
Okay, so you as the buyer would elect to take the seller's unemployment rate if it were more favorable than what you get. And I think, check me if I'm wrong, but a new business defaults to the highest unemployment rate. So what a buyer would be trying to do is get a little bit of preference on that. Is that the case?
Honestly, I think that is true. I haven't looked at that in a while on what your initial rate, if it starts at the highest. I'm not positive on that, being honest.
I appreciate your candor. I think those are the last questions in the chat. I was just running through to make sure we didn't miss anything. I think we addressed everything. This has been Chris. It was a great recording, and we got some great questions from everybody that joined us today. I'd like to thank everybody who joined us on the broadcast here, and hope you were able to take something away from this. And Chris, I'd like to thank you again for participating.
Thank you very much. Appreciate it.